We continue the second part of our discussion. In the previous section, we've already seen the relationship between the stockholders and bondholders, and stockholders and managers, and see how things can go wrong with examples. Now we move on to the relationship between the firm and the financial markets, as well as the firm and the society. So these are the two relationships which we will observe and we'll see, and we'll try and figure out what exactly governs these relationships and what could go wrong in these relationships, right? Now, take a look at this example. We've already seen earlier that Bharti Defense and ABG Shipyard both lost money in this open offer. Now there are two companies, which is company 1 and company 2, who are bidding for a company 3. If there is a bidding war, then the only shareholders who benefit in most cases would be of these companies, right? So here the shareholders benefit. Typically, when there is a bidding war going on, one of these guys is surely going to overpay. If you're going to overpay, this should be negative from the stockholders' perspective, right? But when you look at this in detail, you see that both Bharti and ABG surge on the open offer, which means the stocks go up, right? Shares went up 17%. ABG Shipyard also rose, and the shares rose by 3.5% or something. So how can the shares of both the acquirer and the target both going up? How does that happen? Because when one guy is buying another company, unless we can genuinely say that a lot of value will get created because of this merger, and historically there is no real evidence around this. Most mergers end in failures because the acquirer overpays for the target. If you are overpaying for the target, then the stock price of the acquirer should go down and that of the target should go up. If you're underpaying for the target, then the target price should go up and should go down, and the share price of the acquirer should go up. In any case, one party should benefit more than the other. In a bidding war, it is typically the scene that acquirer will be incorrect, right? Because they'll overpay. They started at 315 and ended up paying somewhere around 560, 570 for the shares. That's almost 90% higher than what the initial price was, right? But both these shares surged, which basically means that financial markets sometimes tend to react incorrectly. So in theory, financial markets are efficient. Managers convey information in a timely manner, and financial markets make judgment on this information based on the true value. As a consequence, a company that invests in good long-term projects will be rewarded. Short-term accounting gimmicks will not lead to increase in market value. Stock price performance is a good measure of company performance, right? In reality, however, this entire efficient market hypothesis has a huge number of holes, as we just saw in our example. Now, technically, ABG and Bharti both should see their shares going down, and Great Offshore should see the shares going up. That's because there are two guys who are in a war to overpay for the assets of Great Offshore. So the shareholder of Great Offshore should benefit in this entire scenario, right? But the stock market actually took the prices of these guys up as well, and this guy up as well, right? So there's something wrong. Why is the actual experience different? That is because sometimes firms manage the information given out to the market, so they delay the bad news. Sometimes they resort to give misleading information. The second problem is investor reaction to the news. There tends to be an overreaction on either side, and we have to be aware of such limitations. The case we just discussed of ABG and Bharti seems to be a case where there is an overreaction on both the sides, right? Finally, there seems to be an evidence of insider trading, right? What is insider trading? Company insiders may have information and they may trade on this before it is made public. This is illegal. This is also unethical, because they have access to information which other publicly available sources do not, and hence they can make money at the expense of someone else who may be just an unsuspecting investor in the company, right? So it is illegal in most geographies, and that kind of acts as a deterrent, but that does not necessarily